In this video, you're going to learn what a trial balance is, why it matters, and how to prepare one, step by step. At this stage, many students feel confused. They've posted to the ledger, but they don't know what to do next, or how to check if everything is correct. That's where the trial balance comes in. I'll show you exactly what it means, why we use it, and how to create it with clear and simple examples. By the end of this video, you'll know how to spot errors, make sure the books are balanced, and feel more confident in your accounting skills. Let's get started. So, what exactly is a trial balance? It's a simple list of all the accounts in your ledger, along with their ending balances. You line them up in two columns, one for debits and one for credits. If the totals are equal, that's a good sign. It means your entries were recorded correctly. But if they don't match, something went wrong, and you'll need to fix it. Just remember, the trial balance is not a financial statement. It's a checkpoint. It helps you catch errors before moving on to the next step. So, why is the trial balance so important? Because it helps you catch errors early, before you move on to financial statements. If something's wrong, this is where you'll see it. A missing entry, a wrong amount, or something posted on the wrong side. It also keeps your records clean and organized. Think of it like a bridge. It connects your ledger to the next step, preparing reports like the income statement and balance sheet. Without it, you're building on shaky ground. So what does a trial balance actually look like? It's a simple two-column table, one side for debits and one side for credits. Each line shows the name of an account and its ending balance taken from the ledger. Here's a basic example. Cash, $2,300 on the debit side. Inventory, $500 on the debit side. Sales revenue, $800 on the credit side. Owner's capital, $2,000 on the credit side. Now let's total both sides. Debit column, $2,300 plus $500, $2,800. Credit column, $800 plus $2,000, $2,800. The totals match, and that's the whole point. A trial balance is only correct if both columns are equal. That means every debit has a matching credit, just like in double entry accounting. If it doesn't balance, there's an error somewhere. Now let's go through a full example and build a trial balance together, step by step. We'll use three simple transactions you've already seen. First, the owner invests $2,000 into the business. This means cash is coming into the business, and owner's capital is increasing. The journal entry is debit cash, $2,000. Credit owner's capital, $2,000. We post $2,000 to the debit side of the cash account and $2,000 to the credit side of the capital account. Done. That's the first transaction. Next, the business buys inventory worth $500 and pays for it in cash. Here, inventory is going up and cash is going down. We record debit inventory, $500, credit cash, $500. So we post $500 to the debit side of the inventory account and $500 to the credit side of the cash account. Now we move to the third transaction. The business makes a cash sale of $800. Cash is increasing again, and revenue is being earned. The journal entry is debit cash, $800. Credit sales revenue, $800. Cash goes on the debit side, and sales revenue goes on the credit side. At this point, we've posted all three transactions into the ledger. Now it's time to create the trial balance. We take the final balance from each account. Cash has a total of $2,300. Inventory has $500. Capital is $2,000. And sales revenue is $800. Now, let's arrange them in a trial balance format. Cash, $2,300. Debit. Inventory, $500. Debit. Capital, $2,000. Credit. Sales revenue, $800. Credit. When we add up both sides, they match. Total debits are $2,800. Total credits are also $2,800. That's what we want. When both sides balance, your trial balance is correct, and your books are in order. This step helps you catch any posting errors before moving on to financial statements. Let's keep going. Now, before we wrap up, Let's go over a few common mistakes students often make when preparing a trial balance, so you can avoid them from the start. The first mistake is using the wrong numbers. Some people accidentally use the amounts from the transactions instead of the ending balances in the ledger. But remember, the trial balance shows final account totals, not each individual entry. Next, watch out for missing accounts. Even if an account only has one entry, it still needs to be included if it has a balance. Leaving it out will cause your totals to be off. Another mistake is when debits don't equal credits. This means something wasn't posted correctly, or an account balance was copied wrong. The whole point of a trial balance is to make sure both sides match. And finally, don't include accounts with zero balances unless you're specifically told to show all accounts. In most cases, we only include accounts with non-zero balances. Double-checking these points helps keep your records clean, organized, and accurate. So, what exactly does the trial balance help with? It catches mistakes like incorrect totals and missing postings. If something didn't get posted or the math is off, the trial balance will show it. But here's what it can't catch. It won't catch if you use the wrong account, like putting a payment under rent when it should have gone to utilities. It won't notice if you recorded the same transaction twice, or if you missed it completely. That's important to remember. Just because your trial balance balances, it doesn't mean your books are perfect. It only checks that the math works, not that the entries were correct. Let's do a quick recap. The trial balance comes after the ledger. It checks if total debits equal total credits and makes sure your accounts are balanced. It's not a report for outsiders, but it is the starting point for creating financial statements. And that's why it matters. If this video helped you understand the trial balance clearly, go ahead and hit like, subscribe for more step-by-step accounting lessons, and drop a comment below if you're ready for part 4, where we dive into the income statement. You've made great progress. Let's keep going.